This is Jody Trana with Chapter 12, Part 1 of Business Finance. Here you can see a typical problem that we've had in our homework. From Chapter 11, we talked about Sabre Electronics and their new capital budgeting project. The cash flows were given to us of these differing amounts every year. Our task was to determine the net present value. For Chapter 12, we're going to talk about these actual cash flow estimates and where they came from and how they were determined. Chapter 12 is going to help us dig deeper into the cash flows that we've talked about for our different projects so far in the class. In Chapters 1 through 11, the projects in the homework, they gave us all the information about the cash flows. Chapter 12 helps us to see where all of these numbers have come from. We are going to dig into cash flow and see how the different elements of cash flow come together to form the actual cash flow that we'll see in our projects and our homework. Cash flows are made up of capital expenditures, free cash flow, working capital, and operating. In order to understand the key concepts in every project, we need to understand these elements. We need to know what incremental cash flows are, the difference between expansion projects and replacement projects. We need to understand sunk costs, opportunity costs, and any externalities that there might be. Here we can see a software program that is currently bringing in $1,200,000 in cash flow. With a significant upgrade, the program should bring in $4,200,000 in cash flow. That means the incremental cash flows are $3 million. That's what we are evaluating. The incremental cash flow refers to the additional cash flow that a firm receives when they take on a new project as compared to not taking on the new project. We need to consider all incidental effects, such as maybe a project might enhance the profitability of some of the existing activities of the firm, or it could detract from the profitability of some of the existing activities. Here you can see a picture of Palm Island in Dubai. This is an artificial offshore island that's in Dubai of the United Arab Emirates. On this site, they have built private residences and hotels. You can probably see that from the air. The island looks like a stylized palm tree within a circle. It was built in the early 21st century, and it's largely financed from Dubai's substantial income from petroleum. This project was built from nothing, absolutely, literally, because they had to build the island itself before they could build the residences on top of it. You can see the costs associated with building this project. The current spend has a total of $53 billion, but the project as a whole is estimated to have an additional $337 billion. So we're talking about close to $400 billion that will be spent on this particular project in Dubai. This is an expansion project because it is brand new and is not replacing anything else. Let's compare Dubai to Lincoln, Nebraska. Here in Lincoln, there are probably some expansion projects, but I've chosen to choose this replacement project to highlight. In a town, when a water main needs to be replaced, we do have some existing infrastructure that will remain. So a replacement project has to consider what is still there and what will be used, as well as what needs to be replaced. Let's talk about the difference between sunk costs and actual costs of the project itself. Sunk costs are paid out whether or not the project is a go-ahead. There are many costs associated with actually just making that initial decision about the project. Since they're incurred in the past, they can't be recovered regardless of the project decision. So they're not relevant to the project cash flows. Things like if we do a market research study, that cost has already been incurred, and it doesn't matter whether we accept the investment or not, that cost is gone. These costs are not part of the project because they don't affect the project itself, they affected the decision. Let's have an example here of Home Depot. If they spend $2 million to get permits to build a new store, whether or not they end up building that store, those costs are paid and they're gone. They're not considered as part of the project. Opportunity cost is the cost of passing up the next best choice when making a decision for a project. For example, let's say that we have to forego rent on a building space in order to accommodate an expansion plan for the existing line of business. That will be a relevant incremental expense because it represents an opportunity cost. Looking at this graphic of Iowa, let's say that a piece of land is owned by JCPenney in southern Iowa. You can see the circle here representing that land. If the land is worth $3 million and the project is accepted, the $3 million becomes part of the project. The $3 million is an opportunity cost. If the new store is not built, JCPenney could sell the land and receive the cash flow of $3 million. Externalities refer to results or consequences of a certain project outside of the project itself. A positive externality can be to the company itself, like when a company develops a new phone accessory, it can boost sales of the phone as well. Negative externalities could be opening a second location. In this example, the second location could take some profits away from the original location. Internet sales could take away from some of the brick and mortar sales. And even introducing a new product will likely take sales away from an existing product. Probably the biggest and most common issue of externalities is the environment, such as a potential result of a project with chemical hazards. The 4 steps in projecting cash flow is: first, identify your operating cash flow. Second, compute the working capital requirements. Third, find or calculate your initial cash outlay. That includes capital expenditures. And fourth, determine your free cash flow. Operating cash flow comes from an analysis of the income statement. It starts with revenue. Revenue is generally thought to bring in cash, which it should, and we subtract cost of goods sold, which we've paid for. That equals our gross profit. We're going to subtract operating expenses from that, which oftentimes in your homework will include depreciation. When we do this, we get to our earnings before interest and taxes, EBIT, also called the net operating income. So one way to do operating cash flow is to actually start with EBIT, depending on the information given to you in your problems. Once we have EBIT, or net operating income, we will subtract taxes because we need to consider that as part of our cash flow out. We do need to pay our taxes. That will equal our net operating profit after taxes, or NOPAT. There's two things that are very important for you to remember. The first is that depreciation expense must be added back into the operating cash flow. Depreciation expense, you'll remember, is an adjustment that we make. It's an adjusting journal entry that's allocating our capital into our expense accounts. It is not an actual cash expense. So since we have deducted it above in our operating expenses, we need to add it back. So this is just a matter of taking depreciation out of the cash flow equation. The second thing to remember is that interest is never part of our operating cash flow calculation. Interest is considered part of our capital structuring. It is our financing of our projects, and we can finance projects in any number of ways, changing our interest expense based on the choice that we choose to cover our expenses, to cover the project. So you'll see here that the only time interest is mentioned is that it is not included in EBIT. So we do not consider interest at all. Many problems that you will receive will have a mention of interest, and you'll need to remember that that is not part of the equation. Step 1 of determining free cash flow is net operating income minus taxes paid plus depreciation to add it back is our operating cash flow. Let's first talk about working capital before we identify how to calculate our working capital requirements for a project. You'll remember that the actual numerical working capital is determined by taking your current assets and subtracting your current liabilities. This identifies the amount of liquid assets that you have that are free and clear of any obligations. So let's look and remind ourselves of what those categories include. Current assets includes cash, accounts receivable, and inventories. All very liquid assets that are expected to turn into cash well before a year. Current liabilities include accounts payable, any short-term debt, and accrued liabilities. Accrued liabilities are any type of short-term obligation that we have that we need to pay. When we have current assets that are greater than current liabilities, we have a positive working capital, and that is our goal as a business finance professional. Now that we're reminded what working capital is, let's talk about working capital and how it relates to a project. What we need to account for is how working capital affects the specific project's cash flow. And we're not going to look at every single account that might be included in working capital. We're going to pull out the basic ones. Now you know everything we're analyzing is about cash. So obviously we're going to end with a cash number. But we're going to take 2 current asset accounts and 1 current liability account and analyze those. They carry the lion's share of our working capital changes, not counting cash. So we're going to look at changes in accounts receivable, in inventory, and in accounts payable. The way we will do this is to look at each account first without the project, then with the project, to identify the difference. Here we're trying to identify incremental changes in these accounts that are affected because of the project. They would not happen without the project. The final goal is to identify the investment needed for our net operating working capital. That is the sum of the increases in accounts receivable, that's the difference between B and A, the increases in inventories, and subtracting the increases in accounts payable. Remember that when we have accounts payable, it stretches our working capital. It gives us a little bit more leeway because we're essentially borrowing money from our vendors and our suppliers. So if we increase accounts payable, it's going to lower our investment in operating working capital. Let's work through an example. Here we have a company that currently today, without any project, has accounts receivable of $600,000. With the project they're considering, they expect accounts receivable to increase to $660,000. That's a difference of $60,000. That is an increase in accounts receivable. The inventory before the project is $390,000. That's how much they need to commit to inventory today. With the project, their inventory needs are going to go up to $426,000. That's an increase of $36,000. Taking a look at their accounts payable, without the project, their accounts payable right now is $180,000. Because of the increased activity and additional purchases, they expect their accounts payable to increase to $198,000. That's an increase of $18,000. If we take on this project, accounts receivable and inventories will increase to $96,000. Those will both be uses of working capital that we need to identify cash for. So that's going to go into our needed cash. However, because our accounts payable balance is also going to increase, we don't need the full $96,000 as we will use $18,000 of other people's money. That reduces our working capital needs for this particular project to $78,000. You can of course memorize that increases in accounts receivable and inventory are added and the increase in accounts payable is subtracted, but I want you to really understand this concept. When accounts receivable and inventory go up, that is an additional investment in cash that is needed. We have to have cash to pay for this. When our accounts payable goes up, though, we're using somebody else's cash for the time being. So any increases in accounts payable reduces our other increases because we're planning to use other people's money. To identify project cash flows, step 1 is to identify your operating cash flows. Step 2 is to identify working capital requirements. We do that by taking our increase in accounts receivable and adding our increase in inventory and subtracting our increase in accounts payable. The third step is to identify your initial cash outlay. This includes capital expenditures, and that number will often be provided. Sometimes there are additional costs that we have to pay out that are included in initial cash outlay. In addition, we also need to, at times, calculate our depreciation. So let's look at the two different aspects of our initial cash outlay. The first is the actual amount, and the second is depreciation. To identify your initial cash outlay, you would start with any equipment costs. This number again would probably be provided. If it wasn't, in a real-life example, you would be collecting prices from different suppliers and determining the features that you need to identify that equipment cost. You would add to that any installation and training because the equipment in and of itself is of no value to you without it being installed and to have your employees trained to use it. Those three costs together comprise your capital expenditures. Sometimes you'll have additional working capital needs that are part of your initial cash outlay. Let's say that you're planning to expand a certain sales division. You would need some inventory up front to boost your inventory balances. This would be part of your initial cash outlay, and even though it is not capital expenditures, it is included in this amount. The depreciation would only be calculated on your capital expenditures, and we will probably always use the straight line depreciation method. It's pretty simple, but you do need to consider if there's any type of salvage value. For this depreciation example, we have an initial cost of $500,000 and a salvage value of $20,000. That makes our depreciable value $480,000 that we would divide over the 10-year expected life to come up with depreciation of $48,000 a year. To determine our project cash flow, we start with step 1, operating cash flows. Step 2, working capital requirements. Step 3, capital expenditure requirements. That is determining the cost of the actual capital purchases for that initial cash outlay and determining straight line depreciation. Now that we have all of our information, we can calculate free cash flow. Free cash flow is the total amount of cash available that we can distribute out to our creditors who've loaned us money or to the owners who've invested in equity for the project. This cash flow information is compiled from many pro forma financial statements. Most of the time you'll be given this information, but we can calculate the free cash flow using this formula. Hopefully you can see the 4 steps that we have taken to identify free cash flow. We start with operating cash flow. We subtract the change in net working capital. We subtract the change in capital expenditures, and what is left is free cash flow. For this project here, let's look at the numbers that they've come up with. Our EBIT, that's where we're going to start for this project. Remember that you can start all the way with sales and subtract cost of goods sold to get your gross profit, subtract your operating income to get your net operating income. But here we're starting with EBIT. Their net operating income is $100,000. The tax rate is 30%. So they're going to pay $30,000. That means our net operating profit after tax is $70,000. The depreciation we're adding back in is $5,000. That was predetermined and is in our EBIT, even though it isn't labeled here. That is part of our operating income. So we need to add that back to identify our operating cash flow. That is step 1. Step 2 is calculated somewhere else, but that is our change in net working capital. The change in net working capital uses cash, so it's going to use some of this operating cash, so it becomes a subtraction from the operating cash flow that comes into the project. The third step is the change in capital expenditures. This is how much we had to pay initially, our initial cash outlay for the project, so that's also a deduction. So what's left is the cash that's free and clear above all of these obligations. And for this project, it is $55,000. Here's one more look at the process to identify project cash flows. You start by identifying the operating cash flow, and then you subtract working capital requirements. You subtract capital expenditure requirements, and that all equals free cash flow.